Investing in equities. It's harder than you think. It's easier than you think. The financial services industry is full of people making promises they can't keep. Promises about beating the market, about picking the best stocks and market timing, and promises about guaranteed returns. The truth is, markets are hard to beat consistently. Picking stocks on the view that prices are wrong is like betting on the horses. It can go either way. Not even the professionals are much good at market timing. And as for guarantees, think about this. If there were no risk in investing, why would there be a return? There is overwhelming evidence that most professional investors are unable to beat their own benchmark. In 2019, SPIVA, S&P's Index versus Active Investing Scorecard for Australia, found that 61.52% of Australian actively managed equity funds underperformed the ASX 200 over 12 months. And it gets worse with time. Over 5 years, a full 80.79% of Australian actively managed equity funds underperformed the ASX 200. So why not just choose those professional investors who outperform? Overall results suggested only a minority of Australian high-performing funds persisted in outperforming their respective benchmarks or consistently stayed in the respective top quartiles for 3 or 5 consecutive years. Among top quartile funds, 9.7% and 2.2% consistently maintained top quartile rankings over consecutive 3- and 5-year periods respectively. Statistically, this result is no better than chance. So why is it so hard to pick the best performing stocks and beat the market? Remember, investing is about making some sort of claim about the future. If we know for certain what a future share price will be, as professional investors claim to, then there would be very little risk in investing in that share. However, think about this. If there were no risk in investing, why would there be a return? Now, the fact is, shares do give higher returns than property, bonds, or cash. This is because of the uncertainty of future share prices. And this uncertainty is due to the simple fact that the current share price of any stock already reflects the future expectations of that share price. So, any future change in the share price will be due to something we don't know about yet. And that is where the risk lies, and with it, the equity premium. We call this the efficient market theory. As Professor Eugene Farmer wrote in 1965, in an efficient market, competition among the many intelligent participants leads to a situation where, at any point in time, actual prices of individual securities already reflect the effects of information based both on events that have already occurred and on events which, as of now, the market expects to take place in the future. In other words, in an efficient market at any point in time, the actual price of a security will be a good estimate of its intrinsic value. This means that any short-term change in share prices will be random, hence the uncertainty, the greater risk, and greater expected return. Professor Burton Malkiel, in his book A Random Walk Down Wall Street, wrote, "A blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. The fact that successful stock picking is no better than chance has been shown in the SPIVA report already mentioned." In fact, a blindfolded monkey would do a much better job than both the experts and the stock market. Rick Ferry, in his article Any Monkey Can Beat the Market, reported that in 2012, Research Affiliates, the investment company, randomly selected 100 portfolios containing 30 stocks from a 1,000 stock universe. They repeated this process every year from 1964 to 2010 and tracked the results. The process replicated 100 monkeys throwing darts at the stock pages each year. Amazingly, on average, 98 of the 100 monkey portfolios beat the 1,000 stock capitalization-weighted stock universe each year. If short-term variations in stock prices are basically random, and picking well-performing portfolios can be done randomly, then is every share in the stock market as good or as bad as any other? Well, no. There is a large amount of evidence that shows only a very small number of shares perform consistently over time. Hendrik Bessembinder, in his paper Do Stocks Outperform Treasury Bills?, has found that the best performing 4% of listed companies explain the returns of the entire US stock market since 1926. The remaining 96% of stocks collectively matched the returns of Treasury bills. Between 1984 and 2014, 67% of stocks underperformed the index and 40% had negative returns. And it gets worse. In 2014, the firm JP Morgan, in a white paper entitled The Agony and the Ecstasy, The Risks and Rewards of a Concentrated Stock Position, found that 40% of companies included in the Russell 3000 index at some point between 1980 and 2014 had suffered a 70% decline from their peak value, recovering to at best a permanent 60% decline in value from their peak. Those catastrophic losses are more frequent for certain industries like information technology, with a 57% catastrophic loss rate, telecommunications at 51%, and energy at 47%. These losses do not only happen during recessions or market corrections, they are happening steadily all the time. 2/3 of all excess returns versus the Russell 3000 index were negative, and 40% of all stocks had negative absolute returns. This means that 67% of stocks underperformed the index over the period, and 40% had negative returns. To summarize, on one hand, it is extremely difficult to consistently pick winning shares. In fact, it is no better than chance. On the other hand, only a very small number of shares explain the entire growth in the stock market. The rest don't do better than government bonds. So what's the best approach to investing in the stock market with its additional risk in order to achieve and capture returns better than a fixed income portfolio? Let's look at the performance of the Australian share market as measured by the S&P ASX 300 index over the past 40 years. $1 invested in a fund that tracked the S&P ASX 300 index would have been worth $57.27 by 2018, compounded monthly. The index consists of all S&P ASX 200 companies, plus 100 smaller cap companies that have market capitalizations above 100 million Australian dollars. The combined market capitalization represents approximately 85% as of March 2017 of Australia's share market. In fact, Australian shares, as defined by the S&P ASX All Ordinaries Accumulation Index, have grown on average 9.61% a year from 1970 to March 2020. During this same period, US shares, as defined by the S&P 500 Total Return Index, have grown on average 11.4% a year. Also during this same period, we experienced an extended bear market in the early 70s, due to the oil embargo crisis, the 1987 market crash, the dot-com bust of the late 90s, the GFC in 2008, and now the COVID-19 pandemic, which we are still going through. In spite of this, world stock markets have delivered above-inflation returns. Despite the lack of evidence demonstrating that consistently picking winning stocks has been successful, historically, the equity and bond markets have provided growth of wealth that has more than offset inflation. The fact is that financial markets have always rewarded long-term investors. While we cannot really know with certainty which are the winning few shares to pick that will give us future growth, we can choose the entire market and stay invested for the long term, knowing that we have a better than average chance of receiving the returns of the equity risk premium, the excess return that investing in the stock market provides over a risk-free rate. A question that you may reasonably ask is, won't choosing the whole market mean that you're also investing in many dud shares, as mentioned earlier? That seems intuitive, right? Let's take a closer look at this. We know that there is no reliable way to predict top performers, so it makes sense to choose the entire market in order to be sure that we capture them when they arise. Between 1994 and 2018, the compounded average year-on-year returns for all shares in the world's major stock markets has been 7.2%. If we excluded the top 10% of performers each year, the returns would have been 2.9%. Excluding the top 25% of performers each year, the returns would have been negative 5.1%. Remember, if we cannot reliably choose a substantial number of top 10 to 25% of performing shares, we risk losing all our returns. But there are other benefits in choosing the whole market. Doing so is in fact easier and cheaper than researching and picking a limited number of shares. So there is no waste or inefficiency for the investor. On the contrary, choosing the whole market reduces any idiosyncratic risk through its broad diversification. Idiosyncratic risk is the risk you don't get rewarded for. Investing in the whole market exposes you to only the market or undiversifiable risk that gives you the higher returns of the equity risk premium. As the founder of Vanguard and pioneer of index investing, John Bogle famously said, "Don't look for the needle in the haystack, just buy the haystack." So, in summary, we know two things from decades of academic research into equity investing. 1. It is practically impossible to pick winning stocks and beat the market consistently. One reason it's so hard to beat the indexes is that all those active managers, all that research, all that marketing costs money. And who pays? You, the investor, pay. You pay in the form of continuing management expenses that lead to diminished returns. Index funds often charge less than 0.1% a year in expenses. Actively managed funds often charge 10 times that much. 2. Investing in the whole market by buying index funds has proven to be a better investing experience. You won't beat the market, but rather you'll keep up with it. And considering that the stock market has historically increased in value over time, that pays off for investors. It is also cheaper than active investing. Even if your active manager keeps up with the market, you are still behind when the higher fees are taken into consideration. And it is simpler and less stressful as there is far less trading taking place, which in turn means decreased volatility in prices and returns. To quote John Bogle again, investing is not nearly as difficult as it looks. Successful investing involves doing a few things right and avoiding serious mistakes.